trade that costs you most may be the one you keep trying to improve. You move the stop because the price is close. You add because the loss now looks cheaper. You search for one more signal, not to understand the market, but to escape the decision you already know you should make. The surprising part is that none of these actions feels reckless while you are doing it. Complexity often enters a trade after discipline has left it. A sound decision usually begins with a simple condition: the price must hold a level, break a range, confirm strength, or prove that your timing is wrong. But once money is at risk, the mind starts negotiating. A clear rule becomes a flexible opinion. A planned loss becomes a temporary setback. A weak position becomes something that merely needs more time. That change in language matters because behavior follows interpretation. If you call a failed breakout, deeper test, you give yourself permission to remain. If you call repeated selling, healthy consolidation, you may ignore evidence that demand is no longer in control. The market has not changed because your explanation became more sophisticated. You must learn to separate what the price is doing from what you need it to do. Watch what happens after your entry. Does the market respond as expected, or does it hesitate where it should move? When price reaches resistance, does buying expand, or do advances repeatedly fail? When a position turns against you, are you studying new evidence, or searching for reasons to avoid a small, defined loss? These observations are simple, but they are not easy. Simplicity removes the shelter of interpretation. A rule such as exit, when the reason for entry is invalid, leaves little room for hope. A limit on position size prevents conviction from turning into financial damage. A requirement to wait for confirmation keeps impatience from disguising itself as foresight. The purpose of a rule is not to predict every outcome. Markets are uncertain, and even a well-formed trade can fail. The purpose of a rule is to decide in advance how you will behave when uncertainty begins working on your judgment. Consider a hypothetical breakout. Price clears a well-defined range, then quickly falls back inside it. The undisciplined response is to collect explanations profit, taking temporary weakness, a late shakeout. The disciplined response is to notice the only fact that matters first. The market failed to remain where strength should have carried it. That fact does not tell you what price must do next. It tells you that the original premise deserves less trust. This is where larger results often begin, not with more trades, more indicators, or stronger opinions, but with fewer opportunities for one bad decision to become a chain of bad decisions. Yet simple rules alone are not enough. A trader can follow a rule perfectly and still follow the wrong rule. The deeper work is learning which rules protect you from uncertainty, which merely comfort you inside it, and how the market reveals the difference before the damage becomes obvious. Before a trade, your rules appear reasonable because they demand nothing from you. After the trade is open, the same rules can feel severe. The rule has not changed. The market may not have changed in any meaningful way. What changes is your relationship to the evidence. Once you hold a position, you are no longer a neutral observer. One outcome now offers relief, while another requires acceptance. That difference quietly alters the standard by which you judge information. Evidence supporting the position is welcomed quickly. Evidence opposing it is questioned, delayed, or explained away. You begin demanding certainty from the warning signs while accepting reassurance from the smallest favorable detail. This is how emotional pressure disguises itself as careful thought. It rarely says, "Ignore your discipline." It says, "This situation may be different." That sentence sounds intelligent because exceptions do exist. But under pressure, the possibility of an exception becomes permission to suspend the rule. The mind is not necessarily searching for truth at that moment. It may be searching for relief. Notice when your analysis becomes more elaborate only after the position becomes uncomfortable. Before entry, perhaps your reasoning required 3 clear facts. Afterward, you suddenly need 10. You move to a shorter chart interval because the larger picture is unpleasant. You focus on a minor favorable movement while dismissing the condition that originally mattered. You seek another opinion, not because your information is incomplete, but because the first answer did not reduce the discomfort. A useful test is simple if you had no position. Would this new argument be strong enough to make you enter now? That question exposes the difference between evidence and attachment. If the answer is no, the argument probably exists to defend ownership rather than justify risk. A position can make weak information feel important because you want the market to confirm a decision that has already become personal. The deeper danger is not the single exception. It is the lesson you teach yourself by making it. Each time immediate relief overrules a prior commitment, the mind learns that discomfort is a valid reason to renegotiate. The next rule becomes easier to bend because the authority of all rules has weakened. Discipline then fails gradually, one reasonable, sounding exception at a time. You cannot prevent discomfort from appearing, nor should you expect confidence to remain steady while money is exposed to uncertainty. The practical task is to deny discomfort the power to issue instructions. A feeling may tell you that a rule is painful. It cannot tell you that the rule is wrong. When you notice the urge to reinterpret, do not argue with yourself at length. Long internal debates favor the position because attachment can produce endless explanations. Instead, identify what entered the reasoning after the trade began. Was this fact available beforehand? Would you respect it if you were flat? Does it challenge the original rule, or merely soften the emotional cost of obeying it? You are not trying to become indifferent. Indifference can be as careless as fear. You are learning to keep separate accounts, one for what the market has shown and another for what the position has made you feel. Both are real, but only one deserves authority over the trade. That separation preserves the rule at the moment of pressure. Yet a rule that survives psychologically still faces another test. It must be precise enough to become an action without hesitation, interpretation, or delay. A trading idea can be correct and still produce a poor trade because the idea was never translated into an exact instruction. You saw the opportunity. You understood what had to happen. But when price reached the critical point, you were still deciding how to act. The market does not execute intentions. It responds only to orders. Words such as enter on strength, buy near support, or wait for confirmation may sound clear during preparation. In live movement, they leave important questions unanswered. How much strength is enough? How near is near? What event confirms the entry? If price moves through the intended level before the order is ready, is the trade still valid at the new price? When those details remain undefined, execution becomes interpretation. Two trades taken from the same idea may be entered at very different prices. A slow entry may increase the distance to the point where the trade is no longer acceptable. A rushed entry may occur before the required event has happened. The analysis may be consistent, yet the actual trades no longer represent the same method. A complete entry instruction must settle several practical matters before price demands an answer. It needs an observable trigger, a chosen order type, an acceptable price boundary, a time condition, and a cancellation condition. These are not administrative details. Together, they determine whether the order expresses the original idea or merely resembles it. Suppose, hypothetically, your trigger is a trade above a defined price. A market order may provide entry, but at an uncertain fill, especially when available liquidity is thin. A limit order may control the price, but leave you unfilled. A stop limit order may activate at the right moment and still fail to execute if price moves beyond the limit. No order type removes uncertainty. Each one chooses which execution risk you are willing to accept. That choice should match the purpose of the trade. If participation matters more than a small difference in price, one method may be suitable. If the idea becomes unattractive beyond a narrow boundary, another may be necessary. The important point is not that one order type is always superior. It is that the order must reflect what the trade requires. Price tolerance deserves equal attention. An intended entry is not an unlimited invitation. If the market moves too far before you are filled, the relationship between entry price and the original premise changes. At some point, you are no longer executing late, you are entering a different trade. A defined maximum price prevents an old idea from being attached to new conditions. Time can invalidate an instruction as surely as price. A trigger expected during an active period may mean something different if it occurs much later, after participation has faded. An unfilled order left resting without a time condition can become active when the reason for placing it is no longer present. Clear execution therefore includes knowing when an order must be cancelled, not merely when it should be entered. You should also know what happens if the order is partially filled, rejected, or duplicated. These events are ordinary operational problems, but they become expensive when handled without a prepared response. If half the intended order fills, will you accept the smaller position, work the remainder, or cancel it? If the platform gives no immediate confirmation, will you verify status before sending another order? Precision here prevents one technical uncertainty from becoming unintended exposure. The test of an execution rule is whether another careful trader could follow it without asking what you meant. If the instruction still depends on phrases such as round, probably, or if it looks good, it remains an opinion rather than a procedure. Exact execution gives a trading idea a stable form. But even when every order is placed exactly as intended, another question remains unanswered. Does the rule produce favorable arithmetic across a series of uncertain outcomes? A trader can be right more often than wrong and still lose money. Another can be wrong on most trades and remain profitable. The difference is not mysterious. Accuracy counts outcomes, while expectancy measures their financial weight. Every method has 4 basic numbers beneath it: how often it wins, how much the average winner earns, how often it loses, and how much the average loser costs. Expectancy combines those numbers into the average result each trade would produce over a sufficiently large series. A high win rate cannot rescue a method whose occasional losses are much larger than its gains. A lower win rate can remain workable when the gains consistently outweigh the losses. Consider a hypothetical method that wins 40% of the time. Its average winner earns 2 risk units, and its average loser loses 1. The winning side contributes 0.8 units per trade, 40% multiplied by 2. The losing side subtracts 0.6 units, 60% multiplied by 1. The difference is a positive 0.2 units per trade before costs. That number is not a promise. A positive average does not determine the result of the next trade, and it does not prevent a sequence of losses. It describes the structure of the wager, not the order in which outcomes will arrive. Uncertainty remains, but the arithmetic tells you whether uncertainty is being accepted on favorable or unfavorable terms. The relationship between the average gain and average loss also determines the break-even win rate. If the average winner is twice the average loser, the method must win more than 1/3 of its trades before costs to have positive expectancy. If winners and losers are equal in size, the required rate rises above 1/2 once costs are included. This is why win rate cannot be judged alone. Its meaning changes with the payoff attached to it. Trading frequency adds another layer. More trades do not automatically create more profit. If expectancy is negative, greater frequency merely repeats a disadvantage faster. If the edge is small, frequent trading may allow commissions, spread, slippage, financing charges, and other costs to consume it. Activity multiplies whatever is already present. Advantage, disadvantage, or noise. The cleanest way to compare trades of different sizes is to use a common risk unit. One risk unit represents the amount planned to be lost if the trade fails at its defined invalidation point. A gain of 2 units and a loss of 1 unit can then be compared without being distorted by the market price or number of shares. This reveals whether results come from the method's payoff structure or from changing exposure. Position size follows from that same logic. The distance between entry and invalidation tells you the risk per share or contract. The amount you are prepared to risk divided by that distance determines the position size. If the invalidation point is farther away, the position must be smaller to keep the financial risk constant. If the position remains unchanged while the distance expands, the trader has increased risk even though the chart may look similar. This calculation also exposes a common illusion. 2 trades with identical dollar profits are not necessarily equal. If the first risked 1 unit to earn 2 and the second risked 4 units to earn 2, their surface result is the same, but their efficiency is very different. Dollars show what happened. Risk units show what was required to produce it. You should therefore judge a rule across a meaningful set of comparable trades using net results after costs. Record the win rate, average gain, average loss, and distribution of outcomes. Then ask which variable is carrying the method. Is the edge coming from frequent small wins, occasional large gains, unusually small losses, or some combination of the three? That question matters because the numbers are not created in isolation. They are produced by the way price behaves under particular conditions. And the same arithmetic can change when the character of the market changes with it. The same chart pattern can produce clean movement one week and repeated failure the next. The shape may look identical. The rule may be applied without error. Yet the outcome changes because a pattern does not act alone. It inherits the behavior of the market surrounding it. A rule is always conditional, whether the trader recognizes the condition or not. A continuation setup depends on price continuing. A reversal setup depends on price rejecting an extreme. When the market stops rewarding the behavior a rule requires, the visible signal may remain while its supporting force has disappeared. In a trending market, movement tends to persist. Advances cover more distance than declines, or declines cover more distance than advances. Pullbacks are contained, broken levels attract little opposing response, and price spends more time moving in the dominant direction than repairing against it. Continuation rules have support because one side is repeatedly willing to transact at less favorable prices. A range behaves differently. Here, movement toward an edge attracts opposition rather than agreement. Higher prices bring in sellers, lower prices bring in buyers. Attempts to leave the range often return because neither side can sustain acceptance beyond the established area. A rule built for continuation may interpret every departure as the beginning of movement, while the market is still rewarding return. Compression is another condition. Price travels less distance, swings overlap, and activity becomes concentrated within a narrowing area. This shows temporary balance, not a guaranteed future direction. The important fact is that movement is being withheld. A rule requiring immediate follow-through has little to work with until participation becomes strong enough to break that balance. Expansion begins when price starts covering greater distance with less resistance. Ranges widen, levels are crossed more quickly, and participation becomes more urgent. But expansion by itself does not prove persistence. A sudden move can represent the start of acceptance at new prices, or it can be a brief search that finds no support. The distinction appears in what happens after a boundary is crossed. If price remains beyond it, continues to transact there, and resists returning, the market is showing acceptance. If price crosses and quickly comes back, the excursion has been rejected. The first behavior can support continuation. The second can reveal a failed auction, a search for business that found too little interest to continue. This is why a false continuation should not be defined merely as a breakout that later loses money. Its structure is more specific. Price advertises movement beyond a known area, attracts participation, then fails to establish business there. The return traps those who treated movement as proof. What looked like strength was only an attempt at strength. Liquidity changes the appearance of these events. In active conditions, meaningful participation can absorb orders while keeping movement orderly. In thin conditions, a small imbalance may push price sharply without broad commitment. Distance alone can therefore mislead. A large move created by scarce liquidity may carry less information than a smaller move supported by sustained transactions. To read the condition, observe three things before naming it: how far price travels, how long it remains in new territory, and how strongly the opposing side responds. Distance shows initiative. Time shows acceptance. Response shows whether the other side can regain control. No single measure settles the matter, but together they reveal the character of the auction. Also notice repetition. One failed departure may be ordinary noise. Several failures at the same boundary show that initiative is repeatedly meeting stronger opposition. Likewise, a market that once returned quickly to familiar prices may begin holding outside them. That change in response can mark a change in condition before the chart receives a convenient label. The purpose is not to forecast every transition, It is to stop demanding trend behavior from balance or reversal behavior from persistent movement. Once you can identify what the market is currently rewarding, a more difficult question follows: which choices should be fixed in advance, and which must remain open to present evidence. A trader can lose clarity without receiving any new information. One moment he is judging whether an opportunity qualifies. The next, he is reconsidering the entire method because one minor detail looks uncertain. The problem is not always the quality of the evidence. Often, it is that every piece of evidence has been given authority over every decision. Trading decisions do not all belong at the same level. First comes eligibility. Is this the kind of opportunity your method is built to consider? Then comes the premise. What condition gives the idea its logic? After that comes permission. What must occur before the idea becomes actionable? Finally comes invalidation. What fact would show that the original reasoning no longer holds? When these questions are answered out of order, weak information can overrule strong information. A small, late detail may cancel a well-supported premise. Then another detail restores it. The trader moves back and forth because no decision has a defined place in the sequence. He is not adapting. He is allowing evidence to compete without rank. A decision hierarchy corrects this by giving each question a proper time and scope. Eligibility decides whether further attention is deserved. The premise decides what behavior matters. Permission decides whether observation may become commitment. Invalidation decides when the premise has lost authority. Each answer narrows the next question instead of reopening all the earlier ones. This matters because markets produce more information than any trader can use. Every movement can support several interpretations if it is allowed to answer an unlimited number of questions. A simple hierarchy reduces that confusion. It tells you not only what to consider, but what a fact is permitted to change. Suppose a minor fluctuation does not contradict the premise. It may affect timing, but it should not decide whether the entire idea belongs in your method. By contrast, a fact that destroys the premise should not be treated as a minor timing issue. The importance of information comes from the decision it changes, not from how noticeable it appears on the screen. Some choices should therefore be settled before the market begins demanding attention. Definitions, exclusions, and the conditions that make an idea valid should not be reinvented each time. They concern the structure of the method. Other choices must remain open because they depend on information that does not yet exist. The purpose is not to remove judgment. It is to reserve judgment for questions that can only be answered in the present. Ask of every trading decision, can this be determined without seeing the next price movement? If the answer is yes, it probably belongs in advance. If the answer is no, define what future evidence will answer it. This prevents a live observation from becoming an excuse to redesign the method while using it. It also helps to separate a closed decision from a live one. A closed decision remains settled unless a specific contradiction appears. A live decision is still awaiting evidence. Without that distinction, the mind keeps working on everything at once. Attention becomes scattered, standards shift, and two similar opportunities can produce opposite choices. A strong decision can often be stated in one line. This opportunity is eligible because a defined condition exists. I will consider commitment only if a separate confirming event occurs. The idea loses validity if its necessary condition disappears. The value of that sentence is not in its wording. It is in the order of authority. Simple decision making does not mean making fewer observations. It means preventing every observation from becoming a new decision. You keep the broad questions stable, allow the narrow questions to arrive in sequence, and reopen an earlier judgment only when evidence reaches the level required to challenge it. But a sound decision structure still has to survive the ordinary pressure of a trading day. Unless it is supported by repeatable preparation and review, even the clearest hierarchy can remain nothing more than a good intention. A trading error often begins long before the order reaches the market. A symbol was never properly reviewed. A scheduled event was overlooked. A key level was marked incorrectly. By the time the mistake becomes visible, it appears to be a failure of judgment, though its true cause was incomplete preparation. Professional habits exist to remove such avoidable variation. They do not make the market predictable. They make your own process less dependent on memory, available attention, and the condition of the moment. When the same essential work is completed in the same order, fewer important details are left to chance. Preparation should begin by narrowing the field. An unlimited watch list creates shallow attention because every symbol competes for observation. A selected list concentrates effort on instruments that meet your basic requirements and removes those that do not. The purpose is not to find constant action. It is to know where attention would be justified if opportunity appears. Each selected instrument should then have a brief scenario prepared, not a forecast, a set of relevant possibilities. What would make the instrument worth watching? What development would make it uninteresting? What scheduled event could change its normal behavior? Scenario work prevents every movement from arriving without context, while leaving the final outcome uncertain. This preparation must remain short enough to use. If reviewing one instrument requires pages of notes, the process may consume the attention it was meant to protect. A useful routine preserves only information that can affect observation or action. Everything else may be interesting, but it is not operational. Alerts provide another form of discipline. Without them, a trader may stare at movement that has not reached a meaningful area. Continuous watching creates noise and divides attention among events that require no response. A well-placed alert allows you to step away until the market reaches a point that deserves inspection. It does not decide anything, it simply calls attention at the proper time. A checklist serves a different purpose. It catches omissions immediately before commitment. Is the instrument correct? Is the intended direction correct? Is a relevant event approaching? Does the planned exposure match what was intended? These questions are simple because the most expensive operational mistakes are often simple. The checklist is not proof that the trade is good. It is protection against sending a trade you did not mean to send. Records should also be factual before they become interpretive. Capture what was planned, what was observed, what action occurred, and whether the process was followed. Memory tends to preserve the striking parts of a session and lose the ordinary details. A record fixes the sequence while it is still clear, so later inspection is based on evidence rather than reconstruction. Review should occur at a scheduled time, separate from the trading session. Reviewing while the market is moving mixes inspection with participation. One demands distance, the other demands attention. When review has its own place, you can examine missed steps, incomplete preparation, unnecessary monitoring, and deviations from routine without interrupting current work. The value of review is not measured by how many changes it produces. Some reviews should produce none. Their purpose is to verify whether the process operated as designed. A system that is altered after every imperfect day never becomes stable enough to inspect. Professional routine values consistency of observation before novelty of adjustment. You can judge the quality of a routine by asking what it removes. Does it reduce forgotten information? Does it narrow unnecessary choices? Does it place attention where it matters? Does it leave a reliable record? If it does none of these, it may be ceremony rather than work. Preparation, alerts, checklists, and review create the conditions for orderly action, but their authority reaches only so far. Once a position is open, the market begins producing new evidence, and the next discipline is knowing how that evidence should change the trade without allowing the result alone to take control. Apposition can show a profit while the trade itself is weakening. It can also show a temporary loss while behaving exactly as the original idea allowed. The running total measures the distance from your entry. It does not measure the present quality of the trade. Quality is judged by comparing actual behavior with expected behavior. Every sound trade begins with an expectation about what price should do if the premise is correct. It may be expected to move promptly, hold a particular area, attract continued participation, or refuse movement in the opposing direction. Management begins when you compare that expectation with what the market delivers. Progress is the first evidence. If the trade was based on immediate pressure, prolonged hesitation matters because the expected force has failed to appear. If the premise allowed time for development, the same hesitation may carry little information. Time is therefore not automatically favorable or unfavorable. Its meaning depends on what the trade required. The manner of adverse movement matters as well. A brief move against the position that meets little continuation is different from sustained movement that repeatedly closes ground and prevents recovery. Both may produce the same temporary loss, but they reveal different levels of opposition. Management should respond to the behavior creating the loss, not merely to the amount displayed. Favorable movement must also be interpreted. A quick profit does not by itself prove that the premise is strengthening. Price may move briefly in your direction and then lose the participation that supported it. By contrast, continued progress, orderly pauses, and successful defense of newly gained ground may confirm that the trade is developing as expected. Profit is an outcome, confirmation is evidence. It helps to place new information into three classes. Confirming evidence strengthens the original premise.